This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City, the evening of April 13th. Well, the panic that never was over Huarong Asset Management has occupied a great deal of headline space in the last 48 hours. Bloomberg News wrote that growing panic over the financial health of one of China's largest bad debt managers spilled into the broader market yesterday. Which is, by the way, completely incorrect. If you look at the chart, which shows a 10-year bond of Huarong Asset Management versus a similar bond of one of the other big four asset managers, Cinda Asset Management, we see that there was practically no change in price. In fact, a small increase in price of the Cinda bond, while the Huarong bond fell by about 20%. Now, all of this was occasioned by the fact that Huarong has troubles all its own, and I emphasize its own. Its chairman was tried for corruption in what is reportedly the largest bribery case in the history of the People's Republic of China, which is saying something, and was sentenced to death in January of this year, and the company failed to report its 2020 financial statements at the end of March, sending its stock into a spiral and leading to speculation in the press that the Chinese government would have to wind up its affairs. That's quite something, because the Chinese government owns 62% of Huarong Asset Management. The private investors who own 38% of the remainder of the company might take a haircut. Now, this is not a systemic problem. The overall reaction in China's credit market was quite calm, but it does point to a bigger problem. 20 years ago, the Chinese government created four big asset managers to offload the distressed debt of the big Chinese state-owned banks. And there that debt has languished. The Chinese government has been unsuccessful in resolving those problems. The portfolios just sat there and festered. And the trouble is that China has a $4 trillion corporate bond market, but the high-yielding section of that bond market remains illiquid, hard to price, opaque, dominated by a few institutions, and frankly, very insidery. There's one mutual fund, one ETF rather, which trades Chinese high-yield debt. I think it has about $15 million worth of assets under management. So the broad public has stayed away from the high-yielding, non-distressed side of the Chinese corporate bond market. And if investors don't want to get involved in functioning high-yield companies, why would they touch distress? So what China really needs is a drastic increase in the efficiency of its high-yield corporate bond market. And there it could learn something from the United States. One of the few things that Wall Street did well was to unlock the liquidity of tens of trillions of dollars of assets tucked away in portfolios which weren't moving. For example, mortgage-backed securities, which resolved the great savings and loan crisis of the 1980s, by taking the mortgage lending business out of the hands of small regional banks and giving it to big institutional investors, or the credit markets, which, with the advent of credit derivatives, made it possible to pool credits and sell parts of the pool to different investors with different risk appetites and different needs. All of that vastly helped improve the allocation of credit in U.S. markets. Granted, the 2008 crisis was in part brought about by these structural changes, but that's because the banks ignored their own credit models rather than follow them. So what China needs is standards of risk assessment and management that make it possible to broaden the base of the high yield market, attract smaller investors, financial institutions, and foreign investors by offering risk gauges that are reliable and generally accepted. That's the American model, something China could learn from. And what the Huarong disaster tells us is that China's credit markets still have a lot of work to do before they're ready for prime time. This is David Goldman speaking to you from New York City.